Throughout history, the fate of nations has rarely been dictated by visible factors alone. Wars, revolutions, and the rise or fall of empires certainly play a role. But there is a subtler, more pervasive force that shapes the world: debt. In the modern era, debt has grown into an omnipresent reality, creating links and obligations not just between countries, but between generations, institutions, and individuals. What is most striking is that every country, regardless of wealth or power, carries immense debt. But if everyone is borrowing, who is lending? The answer is complex, hidden in the labyrinthine workings of global finance. In the background of nearly every economy, you'll find endless chains of IOUs binding governments, corporations, banks, and people together. The United States leads the way with over $38 trillion in public debt. The European Union has accumulated about $14 trillion, and Japan is close to $9 trillion. Even economic giants and resource-rich countries, from Germany to Saudi Arabia, from China to Canada, are deeply indebted. This system is not new, nor is it an accident. Rather, it is the result of centuries of evolution in global finance. The roots of national debt stretch back to the age of kings and empires. In 17th century England, the cost of war against France pushed the monarchy to the brink of financial disaster. Traditional sources of wealth, like gold, were depleted. In response, the government offered wealthy merchants a deal: lend us money and we'll pay you interest, secured by future tax revenues. In 1694, this arrangement led to the creation of the Bank of England and the birth of the government bond. Eventually, this model spread throughout Europe and to the newly formed United States, which funded its own revolution partly through borrowed money. Over time, the ability to borrow big became a symbol, not of weakness, but of a nation's economic credibility and influence. Today, debt shapes the global hierarchy as much as any army or innovation ever has. The United States, for instance, owes much of its debt to its own citizens and institutions. Banks, pension funds, mutual funds, insurance companies, and the Federal Reserve. Foreign holders, such as Japan and China, own a significant portion as well. But most of America's debt is effectively a promise Americans have made to one another. Similar patterns repeat worldwide. Countries lend to each other through bond markets, via international organizations like the IMF and World Bank, or by holding reserves in each other's currencies. This system of mutual indebtedness is surprisingly stable, so long as confidence holds. Global finance functions on a delicate web of trust, in the willingness of governments to honor their commitments, in the value of currencies, and in the promise of continual economic growth. Central banks, such as the Federal Reserve or the European Central Bank, sit at the heart of this system. They do not simply manage existing debt, they are the ultimate creators of credit, buying government bonds and injecting new money into the economy, thus building layer upon layer of financial interdependence. But this engine is not without risks. Recent history offers stark warnings. The Greek debt crisis caused panic in European markets. Repeated defaults in Argentina caused the value of its currency to evaporate. When Sri Lanka was unable to service its foreign debts, the result was political and humanitarian upheaval. In each case, the abstraction of debt suddenly became a harsh reality, revealing the power held by faceless institutions, bondholders, ratings agencies, and global financial bodies. Remarkably, governments do not strive to pay off their debts entirely. Instead, they routinely refinance, or roll over, existing obligations by issuing new bonds to pay off the old. This perpetual cycle isn't a conspiracy, but an openly acknowledged modus operandi. For many investors, government debt is the safest investment on earth, utilized as collateral and accepted as cash equivalent in countless transactions. If the United States or Japan were ever to eliminate their national debts, the fallout would devastate the financial system, destroying its foundation and triggering a deflationary collapse. Debt, then, is not bad in itself. It is essential to the functioning of the modern world. The problem arises when the balance of trust is upset. Interest payments on government debt, funded by taxes, usually flow upwards through society, benefiting the wealthy more than the average citizen. Thus, rising inequality often goes hand in hand with rising indebtedness. Every economic boom, every bailout, and every crisis redistributes risk and reward, often deepening existing divides. Our debt-driven world works as long as confidence in the system persists, but that confidence is fragile. Should it falter, the intricate network of promises, bonds, and obligations would unravel, and the true cost of our borrowed prosperity would be revealed. Until then, debt remains both a crucial tool and a persistent source of tension, linking us to our future, for better or for worse, by the strength of a promise.